Welcome to Impartial Points and our guide to the interplay between the stock market and your economic situation. When you watch the news, you often hear about the stock market. The Dow is up 500 points, or the S&P 500 hit a new record high. It's easy to think that a booming stock market is a sign of a healthy economy, but is it? The answer is more complicated. The stock market is not the same as the overall economy, and sometimes a rising market can be a red flag rather than a cause for celebration. In this explainer, we'll dive into why the stock market doesn't represent the real economy, why a high stock market can spell trouble for the average person, and what tools like the Buffett Indicator tell us about overvalued stocks and economic risks. So, let's get started. The stock market versus the economy. Let's start with the basics. What's the difference between the stock market and the economy? The stock market. The stock market is a collection of exchanges where shares of publicly traded companies are bought and sold. It's a mechanism for investors to gain ownership in businesses and for companies to raise capital. Stock prices generally reflect what investors believe about a company's future profitability. The economy. The economy, on the other hand, is a much broader concept. It includes jobs and wages, employment levels, wages, and worker productivity. Goods and services. The production, distribution, and consumption of goods and services. Consumer spending. How much people are spending on things like housing, food, and healthcare. Government and global trade. Public sector contributions and international trade flows. Why doesn't the stock market represent the economy? The disconnect between the stock market and the economy comes down to a few key points. 1. Who participates in the stock market? About 60% of Americans own stocks, but the majority of that ownership is concentrated among very wealthy individuals. For most people, their wealth is tied to wages, small savings, or assets like a home, not the stock market. So, a soaring market doesn't necessarily benefit the average worker or consumer. 2. The stock market reflects expectations, not realities. Stock prices are based on future expectations, not current economic conditions. Investors buy or sell stocks based on what they believe will happen in the months or years ahead. For instance, during the COVID-19 pandemic, the stock market rebounded quickly, despite high unemployment and widespread economic hardship. Why? Investors expected massive government stimulus and a rapid recovery. The ongoing struggles of average people weren't part of those projections. 3. Stock performance skews toward large corporations. The stock market is dominated by big corporations. Things like the S&P 500 heavily weight tech giants, whose performance often doesn't reflect the struggles of small businesses, which make up a large share of the real economy. 4. Diverging incentives. Companies can boost stock prices without actually contributing to economic growth. For example, stock buybacks, which is when companies purchase their own shares, can inflate stock prices but don't create jobs or new products. When is a booming stock market a bad sign? While rising stocks are often seen as a positive, they can sometimes indicate underlying economic problems that harm the average person. 1. Growing income inequality. As stock prices rise, the wealthy, who own most stocks, see their wealth grow, while wages for average workers may stagnate. This concentration of wealth exacerbates economic inequality, leaving most people behind even during a market boom. The result of the boom continues to make economic inequality worse with each cycle. 2. Overvaluation risks. A high stock market may signal that stocks are overvalued, which can lead to dangerous bubbles. When the bubble bursts, it can trigger widespread economic harm. The Buffett Indicator. One way to measure overvaluation is the Buffett Indicator, named after investor Warren Buffett. This metric compares the total value of the stock market to the country's GDP. A ratio above 100% suggests that stocks are overvalued relative to the economy's actual productivity. At the time this video was produced, the Buffett Indicator is over 200%. Overvalued stocks create instability. When prices don't align with real economic output, corrections, which are sharp declines in stock prices, are almost inevitable. 3. Corporate profits over workers. Sometimes, a rising stock market reflects companies squeezing profits out of cost-cutting measures, such as laying off workers, automating jobs, stagnating wages. While these moves boost shareholder returns, they hurt consumers and workers, leading to long-term economic instability. 4. Speculation and market fragility. When markets are overheated, speculative trading becomes rampant. Investors chase high returns without considering risks, creating an unstable financial system. This kind of behavior was a key factor in the 2008 financial crisis, where risky mortgage-backed securities collapsed, dragging the global economy down with them. The real impacts on consumers and workers. For consumers, rising costs without wage growth. If companies focus on boosting stock prices instead of reinvesting in the workforce, consumers face higher costs without higher incomes. Housing market impacts. When the stock market is booming, wealthy investors may pour money into real estate, driving up housing prices and making it harder for average families to buy homes. Retirement worries. While retirees with investments may benefit from high stock returns, those relying on pensions or Social Security see little benefit and face risks if bubbles burst. For workers, job insecurity. Companies may prioritize stock performance over long-term investment, leading to layoffs or outsourcing. Weaker bargaining power. Stagnant wages and the gig economy erode job stability and benefits, even in a high-performing market. Fewer opportunities. Small businesses, which employ a large share of workers, often struggle during stock market booms dominated by large corporations. Criticisms of using the stock market as an economic barometer. It ignores key metrics. Economic health is better measured by GDP growth, employment rates, and wage growth, not stock performance. Disconnect during crises. The 2020 COVID-19 pandemic showed how the market can surge even when millions are unemployed. Unequal benefits. Gains are concentrated among institutional investors and high-income individuals, leaving most Americans unaffected. How to read the signals. 1. Watch the Buffett Indicator. When the Buffett Indicator signals overvaluation, it's a warning sign that the market is out of sync with the economy. 2. Monitor wage growth and employment. Healthy economies grow when wages rise and unemployment falls. If the stock market is booming without these metrics improving, it's a red flag. In summary, the stock market and the economy are not the same thing. While the market can be an indicator of investor sentiment and corporate performance, it often ignores the realities of everyday life for most people. A booming stock market might feel like a win, but if it's driven by overvaluation, speculation, or corporate cost-cutting, it can be a warning sign of trouble ahead. By understanding tools like the Buffett Indicator and the risks of overvalued stocks, we can better evaluate the market's impact on the real economy and on our own lives. So next time you hear about record highs on Wall Street, take a step back and ask, what does this really mean for me? Many times, a team mentality leads a lot of Americans to feel better if the stock market is hitting record highs. Sometimes, Americans don't even consider that the booming stock market might be coming at their expense. We hope you found this discussion informative and insightful. Until next time, stay curious and keep exploring the world of information at your fingertips. If you found this video helpful, please like, subscribe, and share with others. Join us next time on Impartial Points.